Understanding market corrections. This chapter explains what a market correction is, including the difference between a pullback, correction, bear market, and crash. It discusses historical examples of 50% corrections, e.g., 2008, 2000 Great Depression, the psychological and technical signals that precede them, and the natural cyclical behavior of markets. This chapter sets the tone by demystifying fear around market corrections and providing context for long-term investors. Investor psychology during crashes. This chapter explores the emotional roller coaster investors go through in a downturn. It introduces behavioral finance principles like loss aversion, herd mentality, and panic selling. Real stories of investor mistakes during past crashes are shared to emphasize why controlling emotions is more valuable than timing the market. The importance of discipline and long-term thinking is reinforced. The cost of panic selling. This section provides a mathematical and emotional analysis of panic selling. It breaks down what happens when investors sell at the bottom and miss rebounds. Using charts, timelines, and case studies, the reader sees how devastating missing just a few big recovery days can be. Key takeaway: staying invested is often less risky than trying to avoid every dip. Portfolio risk assessment readers are taught how to evaluate their portfolio's risk profile. The chapter discusses asset allocation, sector overexposure, and the importance of diversification. Tools like the Sharpe ratio, beta, and risk tolerance quizzes are introduced. Readers are encouraged to assess their personal financial goals, time horizon, and risk appetite, building a defensive portfolio. This section walks through how to shift toward a defensive investment strategy. Topics include increasing allocations to dividend stocks, value equities, consumer staples, healthcare, and gold. It also covers bond laddering, cash reserves, and using low-volatility ETFs. Practical advice on making gradual changes is emphasized over panic reallocation. Emergency funds and liquidity planning. An essential chapter for financial resilience. It outlines how much emergency savings investors should have, how to build liquidity buffers, and where to park cash for safety and yield. It explains the concept of sleep well at night money and provides tools to calculate the right amount of reserves based on expenses, income stability, and goals. Buying opportunities in a crash. This chapter flips the narrative. Corrections can be wealth-building events. It teaches how to identify undervalued assets, strong companies temporarily mispriced, and sectors poised for post-crash growth. Dollar-cost averaging, value investing principles, and Warren Buffett's mindset are detailed to help viewers spot smart entry points. Tax loss harvesting and rebalancing. Investors are taught how to take advantage of portfolio losses through tax strategies. It explains what tax loss harvesting is, how to avoid wash-sale rules, and the benefits of strategic rebalancing during corrections. Real-world scenarios show how this can turn a market downturn into a long-term tax benefit. Passive versus active management. During downturns, this chapter compares the effectiveness of passive indexing versus active strategies during crashes. It discusses when active management can offer downside protection, but also highlights the long-term success of diversified passive portfolios. Case studies and data comparisons provide clarity. Mindset and long-term vision. The final chapter is about perspective. It reinforces the need for emotional discipline, patience, and optimism. It revisits history to show how all market crashes eventually led to recoveries. The power of compounding, staying invested, and having a long-term plan are the final lessons. It ends with a strong motivational call to action.